I'm going to put a slide on the screen here, and I know there's a ton on the slide, but stick with me and try not to jump ahead. So what we're going to do is break down this chart like almost a choose your own adventure story for the markets. So let's do it. First big question, all the way to the left. Will growth be structurally weaker than before the pandemic? Best case? No, it won't. That's the scenario we all want to see, right? That's where the economy keeps enough momentum to avoid a long-term slowdown. But even if growth isn't structurally weak, the next big question is, will there be a recession in the next 12 months? If no, we get to the dream scenario. You've got easing supply constraints, that boosts growth, and then picture this, AI and productivity gains. So with companies getting more efficient because of that, that supercharges growth even more. Inflation cools off, the Fed cuts rates, and both stocks and bonds rally. Sounds great, right? But if yes, we hit what I would call a rescued hard landing. Rate hikes take a bit of a bite out of growth, but here's the silver lining. The inflation drops below target. The Fed steps in with big rate cuts after big hikes, which helps bonds outperform and eventually gives stocks a chance to rebound. Now, big question is, what happens if growth is structurally weaker than before the pandemic? So we go the other way now. That's when things get a little bit trickier. So if it's yes, that poses the next question. Will overall yields be higher than what the market's actually pricing in now? If no, we're in for subdued growth, stubborn inflation, growth crawls along, inflation refuses to fully cool, and rates stay higher for longer, making it tougher for both stocks and bonds to shine. Now, if yes, yields are higher, and yields are higher than what the market is pricing in, then we've got to ask, has the market overpriced these AI-based valuations? Now, if they have, then welcome to high rates and hard landing. Inflation stays sticky, the Fed is forced to hike further, and growth slows, and stocks and bonds both take it on the chin and take a hit. Now, if not, and AI efficiency is being appropriately priced into these stock prices, even if growth slows, U.S. companies show up strong. Profits hold steady, the AI rally keeps lifting stocks, and that makes U.S. equities a bright spot. So that would be proof that solid fundamentals can still win even if we do have a softer economy. Now, this decision tree helps us see how the pieces could really all fall in place, which is why I show it to you. But the key takeaway, the best case scenarios are possible, but they depend on growth, resilience, and most of all, inflation still cooling. So staying nimble and adaptable is going to be critical to navigating all of this year.